Wonderful.
So,
Great.
so hopefully, whereabouts are you, James?
We live in Barnes in southwest London,
Very good.
but I'm currently in Mayfair. Yeah, Barnes is great. We just
Hmm.
need to get Heathrow shut down. It would be perfect. Like it is a bit of a long shot, I accept.
Yeah, yeah. I think that's here to stay.
Yeah, I think we should move it east, move it to the east, but I know that wouldn't be very popular, probably with you or anybody else.
Well, exactly, exactly. They've talked about it a couple of times. I mean, Boris had his idea of the island
Yeah.
in the estuary,
Morning.
which hello, is
Yeah.
that you, Eamon?
Yes, sorry to cut you guys off. Just to let you know, you guys are live on YouTube, so don't say anything you don't want out there.
Okay.
Fine. Okay, well, I'll tell you what, we've got 5 minutes. What I'll do is I'll mute my mic and shut my
I'll do the
camera
same
down,
thing.
and I'll come back in
Okay.
5 minutes. And when I've finished doing the little round-up of the news, I'll bring you on. If you could stay muted until then and switch on your camera, then that would be perfect. Does that all make sense?
Yep.
Excellent. Right. See you in a few minutes then.
Yep.
Right. Good morning, everybody. It's 11 a.m., so it's time to get the show on the world. Show on the road. So as usual, I'm going to run through the sort of more interesting bits of the week's news. Obviously, as you can imagine, it's a short week and we are in the sort of depths of August. So it's been a little bit quiet, but there's actually a few interesting things that I sort of want to talk about. And then I'm going to bring on James Harries of Troy Asset Management, who's going to talk to us about STS Global Income and Growth. But first of all, before that, I just want to have a quick look at what's going on in the renewable stroke infrastructure sectors. Now, sort of key thing here is that obviously with the fundraising window currently closed, funds have been trading at a discount in a sort of environment of higher interest rates. There's sort of recently been a trend of funds selling down assets. So first of all, try and sort of validate their NAVs and hopefully sort of close those discounts. They're sort of using that to reduce gearing, obviously, given a backdrop of higher interest rates. Fund buybacks, once again, to sort of help with the discount and sort of fund new investments, because a lot of these are also NAV accretive. And the sort of reason that this has kind of popped up is that in the depths of August, Orit's just achieved a sale. So what it has done is sold its, and I can't even begin to pronounce that, but it sold an onshore wind farm in Sweden for sort of about 74 million euros. There's a couple of interesting things here. So over the life of the investment, it's achieved an internal rate of return of 11.3%. But the sort of sale price is a 1.4 million premium to the sort of prevailing valuation NAV prior to the sale. Now, sort of 0.8 million of that was included in the end June NAV, and there's going to be an additional sort of 0.6 million reflected in the 3rd of September NAV. And as I said, is kind of the trend. The proceeds are predominantly going to be used to repay down the short-term debt facility. And what that's going to do is going to bring the gearing down from about 46% at the end of June to about 43%. And so you can see with sort of funds doing this, the margin, the whole sort of dynamics of the thing is changing. But where people have sort of worried about the validity of those NAVs, and I'll sort of come on to this in a bit. Once again, these guys have achieved a premium to what was sort of in the NAV, and you're sort of very much seeing that. As I said, other funds are doing sort of similar things. I just pulled out 4 relatively recent transactions here, just to sort of give you some idea of what's going on here. So, JLEN Environmental Assets sold 51% of its AD portfolio. That's sort of anaerobic digestion portfolio. This is the sort of biogas stuff, to 3i Infrastructure, and that was in August. But once again, the valuation for that was in line with what it had in its NAV at the end of June. Bluefield Solar, towards the end of July, announced it moved on to sort of phase 2 of its strategic partnership with the sort of group of pension funds, the GLI Infrastructure. Once again, this validated the valuations in the NAV. Remember rightly, they got a sort of small premium there, and they got 70 million out of it, which they used to reduce leverage. And actually, the next stage that they'll be moving on to will be to actually use some sort of proceeds to move on and actually develop some more assets in conjunction with these guys, because once again, that's NAV accretive. Prior to that, just pulled out Next Energy Solar. That sold its Whitecross solar plant. Competitive sales process. Once again, that added 0.57 pence to its NAV, because they'd obviously sold at a premium to which they used proceeds of to reduce debt. And they also launched a 20 million buyback program as well, once again, to kind of sort of waive or hopefully reduce the discount. Slightly different to all of those with GCP Infrastructure. Obviously, this is very much focused on the debt side. But that was able to achieve, I think it was back in April, sale of some sort of loan notes in relation to the Black Crane wind farm. Got 6.4% premium to NAV, once again used to sort of pay down debt. And I just think the sort of key thing to take away from here is where people have been worrying about the NAVs, the sort of kind of sales we're seeing are either in line with or at a premium to. So actually, there's clearly sort of decent value there. And if you look at who's buying these things, you can certainly argue that private markets are once again putting a bit more of a premium on these things than listed markets are at the moment. Next thing I just wanted to talk about, because this came out kind of this morning and yesterday, was Artemis Alpha and Schroders Capital Global Innovation. They've both got a holding in a sort of private company called Reaction Engines, which does clever things for basically aerospace engines. Now, Artemis's sort of announcement this morning, they've written their holding down by 75%. and that follows a sort of 25% write down in April. It's not a sort of huge fund. So, this is not really great news. Position was 6.4 million end of April, now 1.2 million. There's a good chance a lot of this could come right, but what they're basically saying, there's sort of been significant progress in commercializing technology, but recent revenue growth has been slower than anticipated. And really, this has forced the company to go out and get more money. So they are pursuing an internally led fundraise, which is likely to be at a discount to the last valuation. Now, Inov basically said all of the above, but they also said that, to get this into cash positive, it's going to require further investment. Obviously, they're raising money, but it's actually appointed advisors, so it's getting out there and doing this. Inov's position was 10.6 million at the end of December, and that's now 1.4 million. So, they say the sort of overall cost of NAV is about 4.8%. Next thing I wanted to talk about was PRS REIT, sort of fresh out. Today, it's had a requisition request from a good group of investors. Some sort of usual names you might expect. They're sort of Harwood Capital, Waverton, CCLA, Order. Perhaps the sort of surprise there was CG Asset Management. What they want to do is they want to get rid of the chairman, Stephen Smith, and get rid of another of the non-exec directors, David Francis. And they want to appoint Rob Naylor as chairman, and they want to bring in Christopher Mills of Harwood Capital as a director. Now, collectively, this sort of group of investors owns, they say, 17.3% of PRS SARS sort of capital. Harwood, obviously, which Chris Mills leads, owns about 1.1%. They also say that they've been told that sort of rougher and asset value investors who've collectively got 1.6% have said they're going to vote in favour of these resolutions. So you've got circa 20% already saying they're going to do that, but clearly there's a sort of long way to go. PRS says that it's taking advice as to the validity of the request. I mean, at face value, it looks valid. It clearly clears the threshold. What I thought was perhaps just worth noting here is that Naylor and Mills both joined sort of Hypnosis Song Fund's board when really they needed to clear out there. And these guys came in and sort of, I think Naylor in particular drove as chairman a lot of the sorting out, obviously the sale of the portfolio to Blackstone, etc. And I think they, given that was quite a mess, they did a sort of pretty decent job of that. I think perhaps what was a little bit sticky was that they were sort of both paid an extra 250,000, along with all the other directions, I should say, to compensate them for their increased workload to complete the sale. Now, I think neither of them on the board was sort of very, very long at that point, and there was certainly a strong argument that they knew what they were getting involved with when they joined the board anyway. So I think that sort of left a little bit of taste in the market's mouth. So we have to see what happens. I mean, with Song, that was a much bigger fund. It could absorb something like that. Whether PRS could, I don't know. But that's perhaps something for shareholders to think about. Right, that's all that I wanted to talk about. Obviously, we've got some disclaimers here. Obviously, please do take a moment to read those. If you can't at the moment, then obviously perhaps pop back a bit later. Now, I'd like to bring in James Harries to talk to us about ST Global Income and Growth. Good morning, James.
Morning, Matthew.
So for those of you that sort of don't know James, he joined Troy in 2016 to establish their Trojan Global Income Fund. He was also co-manager of the Trojan Ethical Global Income Fund and obviously STS Global Income and Growth. He leads on that. Previously, he was at Newton, where he established and managed the Global Income Fund and was an alternate manager on the sort of Newton Real Return Fund. James, I mean, for those that perhaps not familiar with the trust or could do with a refresh, could you just perhaps spend a sort of few minutes giving us, extended elevator pitch? Tell us sort of why STS and why now?
Well, absolutely. First of all, good morning, everybody. And thank you, Matthew, for the opportunity to be on today. I'm just listening to everything you've been saying. One's reminded of the amazing diversity in the investment trust sector and the complexity and the range of different sorts of assets and infrastructure and solar and private equity and so on and so forth. We're a long way from any of that. We are trying to be very much sort of plain vanilla, high quality, long-term global equity income investors. And we're trying effectively to build a portfolio that we think is resilient and predictable, and will generate a decent and growing free cash flow yield, which in turn will fund a decent income yield. Once we've established a portfolio of investments, we want to interrupt that compounding reluctantly. So we have very low turnover in the portfolio of circa 9%. So it's about 32 companies in the portfolio, 9% turnover. So only 2 or 3 new ideas a year. And then we want the income that we generate to be backed by genuine cash flow and to be derived from income. So we tend to invest in capital-light businesses that can both invest to sustain their competitive advantages, which is the hallmark of quality, but also distribute a reasonable income. And if we do all of that, what we would hope to be is seen as the high quality, low volatility global income trust in the industry. And we think both of those things matter. In our minds, our core client base are those who probably have irreplaceable capital, which I guess is another way of saying are retired, and are in need of income, wish to cover some of their dated bills with income so as not to have to dip into capital in times of stress. And so if we can do that, we would we think that it represents a reasonable place for people's portfolio for the more conservative end of where their equity investments.
Excellent. Sorry,
sorry, go on.
They're gone.
No, I was just going to say over to you.
All right, okay. Well, perhaps let's have just a look at what's in the portfolio. Obviously, you say, you're very much looking for resilient companies. I mean, what does that perhaps mean to you?
Well, if you so onto that slide you've just shown up. So resiliency, I think, is probably a bit of an underappreciated quality at the moment, in the sense that we think we are not alone in saying this, but it is rather remarkable that we've had some of the fastest and furthest interest rate increases for 40 years. And yet equity markets are still trading towards the upper end of the historic range in the US, not so much elsewhere. And effectively what that means is that we're in a world of extremes in many senses. We're extremes in terms of valuation, extremes arguably in terms of sentiment, extremes in terms of concentration, extremes in terms of bond equity valuation, i.e. the equity risk premium is pretty low at the moment. And so we think that that's a juncture at which perhaps being conservative in the way you allocate capital is sensible. And so that's the way we see things. So if you go to the next slide, which is showing exactly that, which is rates have gone up a lot, but the curve was inverted and is now disinverting, which is usually what happens just before a slowdown, if not necessarily a recession. Next slide, please. Yet valuations are towards that upper historic range, in the US at least. Clearly, we've got this AI thing going on at the moment. We can talk more about that. The longevity of that and the economics of that longer term are, I think, uncertain as well at the moment. And so, we've been lagging this market because we're a conservative investor and we're not at Troy tend to chasing what's currently very exciting or what's currently in vogue. But we do think it's somewhat ironic that maybe, for all the reasons I've said, a conservatively managed global income portfolio might be exactly what you want for a proportion of your assets from here. So next slide, please. This is how we go about investing at Troy. We tend to concentrate in particular sectors and particular businesses, which we consider to have sustainable competitive advantages, which tend to have structurally higher returns on capital than others, and for those reasons sit well in our portfolios. And clearly, one of those particularly has had a tougher time recently, so consumer staples, partly because of the advent of GLP-1s, weight loss drugs, Wegovy, and so on. We're not convinced that invalidates their business models. We think ultimately people will still want to perhaps go and have a pint or potentially eat a bar of chocolate or whatever it might be. And that therefore they remain a very valid, in terms of their predictability, in terms of their brands, their margin structure, their dependability. We actually think that they're a very reasonable place still to be investing. And actually, it's very notable that in this world where it would appear to me at least, we've seen a bit of a change of tone in markets. Yeah. I'm always loath to or worried about quoting Stan Druckenmiller, the US hedge fund manager, because he can change his mind very quickly. But what he did say once, which resonated with me, was the inside of the stock market is one of the best economic forecasters there is. And there appears to be a bit of a change going on, and the market's been led more by these more defensive sectors. And there's an irony to me that one of the sectors which would do terribly well in a more challenging environment is now very out of favor just at the time when you may want to be investing in it. And I would put the consumer staples in that category. And there are other areas where we largely avoid because of their cyclicality, because of their capital intensity. Next slide, please. So this is what the portfolio looks like. Clearly, within consumer staples, one or two of those businesses had a bit of a challenging period for various reasons. Reckitt Benckiser largely because of the court case in the US, which we can talk about in more detail. But we think ultimately the liability they face will be lower than is currently implied by the share price fall. And therefore, it represents very good value here. It's a very unfortunate situation. And again, we can talk in more detail about that. Diageo is very interesting. Pernod also this week. These are very generally pretty predictable, dependable businesses. They're seen as more cyclical within staples, but actually they're not that cyclical. However, because we were all stuck at home and, shall we say, probably entertaining ourselves via our drinks cabinet more than would often be the case, these uncyclical companies had a cycle. And so they had excess demand during COVID, and now that's coming out the other side. We think that that's a cyclical phenomenon, though, and they'll refine their feet, and the quality of these businesses will reestablish. And so we've actually been adding to Pernod, and we have a decent allocation to Diageo and Pernod. We have a number of platform businesses. So Chicago Mercantile Exchange is brilliant for gaining exposure to the structural increase in hedging of interest rate risk, of inflation risk, and so on. IHG is a lovely platform hotel business, and Nintendo we love because they're going to launch the Switch Pro next year, and it's a wonderful group of very valuable long-term assets. We've got a number of software businesses. Paychex and ADP are actually listed as industrials these days, but they're really an outsourced HR software stack. Very nice businesses and long-term compounding high-quality companies. And you can see others we have too. And then we've got a number of businesses we've grouped together by historically dependable yield, but they're all world-class businesses. Medtronic seems to be finding its feet after a few years of being somewhat lackluster post-COVID. McDonald's is taking share in a more challenging consumer environment, and so on. Next slide, please. Ultimately, I started by saying we want to be the high-quality, low-volatility trust in the sector at a time when we think that valuations look pretty elevated. And what we're trying to show here is in a nutshell what we're trying to achieve. So you can see that we're generating about a 5.3% free cash flow yield. And that's supported, as you can see on the right-hand side, by a very high-quality portfolio in terms of underlying metrics of the portfolio. Now, we've grown our dividend pretty consistently at approximately 5% over a long period of time, both in our open-ended structure and more recently in the closed-ended structure, STS Global Income and Growth Trust. If you take a forward expected return idea, so free cash flow yield plus the growth in the free cash flow yield, you can get an indication of what's a reasonable expectation of return. If we got a 5.3% free cash yield, which looks good value in absolute terms relative to markets, we think could pretty persistently grow at 5%, then we should be able to generate high single-digit, low double-digit returns from here. Now, if we're able to do that at a time when the market's more challenged, I think that would be a great result.
Excellent. Okay, just want to sort of pick up, I noticed on the, I think, previous slide. Obviously, there's quite an interesting mix of companies here.
Yeah.
Obviously, on one hand, you say you've got these, consumer goods stocks, sort of classic, high free cash flow yielding companies. And then obviously you've got some sort of quite interesting, I guess, sort of newer technology stocks. I'm seeing the sort of Microsoft, etc. I just wanted to go back to your comment about sort of AI, perhaps explore that at this point. I mean, how much of the portfolio would you say is exposed to AI? And obviously the impression that I get is that you're very much cautious on this. So perhaps we could just explore your view around that. Well,
I guess one of the things we're cautious about is that, first of all, the most direct beneficiary that people are identifying, we had NVIDIA's results earlier this week, is the semiconductor industry, and they are the so-called picks and shovels currently, and they are benefiting from the amazing capex boom that we're currently seeing. But we have seen this before. And I'm sure investors will be aware of Amara's law, which says that basically we overestimate the impact of technological changes in the short term, and we underestimate them in the long term. And I do wonder if this is a good example of that, whereby capital is being allocated currently not because of the return that necessarily will be generating, but because each of the big companies, the Mag 7, so to speak, see this as an existential threat to their business and therefore don't think they have a choice. But at some point, they're rational capital allocators. And it may be that the spending slows, and we've seen that in capital expenditure cycles in the past. Ironically enough, maybe at that point, and particularly if we're moving into an economic slowdown. So I'm not. It's not that I'm skeptical on the benefits of AI. What I'm skeptical of is the valuations that are currently ascribed to businesses that are seen as great beneficiaries of AI in the short term, particularly given that these tend to be quite cyclical businesses, many of them. I wonder if somewhat ironically, we're about to have an economic cycle effectively for the first time in 25 years. So the last real recession we had was 2000, which, there are obviously echoes to today. Nothing's exactly the same, but there are echoes. 2007 was about sort of banking and finance and over-leveraging the state. COVID was COVID. We haven't really had that sort of bit too much inflation, therefore we have to put up rates, then we have to take a bit of pain, therefore we have to have a credit cycle, therefore we have a slowdown, then we all move on. We haven't had that for 25 years. And it's deeply unfamiliar, therefore. And I do wonder if that is what appears to be beginning to unfold. And that's what, if you just park the AI bit for a second, that's what appears to be happening on an underlying basis. I mean, AI is amazing. The sums that are being spent are amazing. The results that are being generated by the NVIDIAs of this world are amazing. But the question is whether they've been over discounted in the short term, and looking at the NVIDIA share price, that may be the case.
Okay, no, that makes a lot of sense. I mean, what have you done with your sort of own holdings that, whether sort of directly or incidentally are exposed to this theme? I'm just thinking about, obviously Microsoft pops up there. Is that sort of things that you're monitoring closely? Have you been perhaps taking them down a bit, or?
Yeah, so we haven't done a great deal directly as a result of AI. Clearly, had we predicted what was happening, we would have done more, but we didn't. Microsoft's an interesting one. We bought Microsoft in our previous existence, so to speak, in 2013, when it was on a 13% free cash flow yield, and everyone thought it was going to be put out of business by Google. It's easy to forget that, but that was the case then. And yet we thought that the core Office franchise had a lock on desktop PCs effectively, and therefore it was a fantastic investment. And that's turned out to be, no one knew about the cloud, no one knew about Azure, no one knew about Copilot, no one knew about Teams. These are all things that have happened in the interim. But it still remains a fantastically positioned business. And interestingly enough, we've tried out Copilot at Troy. We haven't yet found a particularly useful use for it, which I think is probably could be quite instructive for other businesses. We're trying to do the same thing. We think this is going to be interesting, but we're not quite there yet. Similarly, RELX is a business that we added to when it was seen as perhaps being disrupted by AI, and is now seen as a great beneficiary of AI. And so the valuation's moved a long way. Both lovely businesses, both long-term holdings. So the answer is we haven't done a great deal. We like these businesses. We like them long-term. If anything, we'd be minded to reduce rather than to add at this point, because clearly valuations have moved a long way. But we think that AI ultimately will just be table stakes. Every business will use AI. Everybody will be seeking to employ it in a way that increases productivity and efficiency. And you'll be substituting effectively compute for humans, which will be a additive to productivity, if not to the poor individuals who find themselves on the wrong side of that. But it's one lens through which you should view capital allocation and stock selection, and it happens to be particularly up front and center at the moment. But I suspect that won't always be the way.
Yeah. Okay. Just wanted to quickly kick over the trace a little bit with Nintendo. So obviously we're sort of talking about the Switch business there. Obviously, they've been through a number of console cycles, etc. And I know that they've experimented sort of recently with mobile, etc. And I got the impression that sort of hadn't perhaps worked so well.
Yeah, so stepping back, ultimately, Nintendo holds unbelievable IP, as we know. It has these assets, which, I see my boys play with their Nintendo just as I used to as a boy. And and basically the offering is, the compute's changed, but the offering's unchanged. It's still, Mario, and it's still Zelda, and it's still, all of those incredible franchises that are evergreen and family friendly, importantly. And so that's the reality. And it's the case that they're being more vociferous or more energetic about monetizing that IP, as we know, not just via video games, but via theme parks and films. And I hope everybody went to see the Mario Brothers movie. I had to see it twice, and which was quite painful. But anyway, and there's more to come. There's going to be a Donkey Kong. There's going to be another Mario, and so on and so forth. Now, on the console business, this is where it gets really interesting, because you're dead right that there's been hits and misses in the past. We all remember the Wii, which was radically different from the previous console. Was a great success. The one after wasn't a success, and it gave Nintendo a reputation of being a bit boom bust. Now, what's interesting now is that the Switch, which is the current console, is one of the most successful consoles of all time. Point one. Point two, we think that the interoperability of the new Switch with the current Switch will be far higher than has been in the past, and therefore will be an iteration rather than a completely radically new. I mean, it's Nintendo. Never say never. They can sometimes do things to surprise you, but we think it'll be much more of a sort of iteration of the current console. The second point, and crucially, is it used to be that a games machine was something you took off the shelf, you played, you could put it back on the shelf, and that was it. Now it's effectively a platform rather than just a console. You update the operating system via Wi-Fi, you download the software via Wi-Fi, which is positive for margins, and you have an individual account with Nintendo. And that means that there's effectively an installed base of north of 100 million users who tend to be quite passionate, who we think will transfer onto the new console in a way that's more predictable than would have been the case in the past because of this relationship and because of this platform idea. Now, if the market gets a handle on that and gets visibility on that, and the Switch 2, which they've said will be launched by the end of March 2025, so we're very close to that, to something being announced. We think that should be taken positively by the share price, and it was very cheap. It's less cheap than it was. There is still a sort of element of cyclicality as the current Switch wanes, particularly because they've now announced the time frame means that the cannibalization of the existing one relative to the new one is now more of a reality than it was, and they tend to distribute a proportion of EPS rather than a progressive dividend, which means there'll likely be somewhat of a dividend cut this year relative to last year. But putting it all together, we think that the quality of the IP, the launch of the new Switch, the games that'll come with it, and everything I've said about the platform relative to a console, we think it makes for a really compelling investment case.
Cool. One sort of question I've kind of related to all of this. Obviously, you were sort of saying that with sort of some of these businesses obviously being less exposed to sort of AI, perhaps being a little bit more out of favor, but generating a lot of sort of free cash flow. Have you kind of seen, I guess, returns perhaps via buybacks, sort of capital returns, that kind of thing, moving up at all? I'm just wondering
buybacks in terms of our underlying companies.
Yeah.
Well, because of the quality of the companies that we invest in, they tend to be fairly conservatively financed. They tend to be very cash generative. Most of them are both paying dividends and doing buybacks. And some of them are quite impactful. So we do have a couple of three holdings, in fact, in what traditionally was called the tobacco sector, but is now called the nicotine consumer product sector by us, if not by everybody else yet, because it won't be a tobacco sector for much longer. They're buying back stock pretty aggressively in the case of Imperial, much less aggressively in terms of BAT, and PMI being their balance sheet back to earth following their very astute purchase of Swedish Match, which has given them this modern oral product in the States and elsewhere. But it's a good example of when the company is cheap and buying back its own stock, it can generate decent returns even in a weaker market. So we don't take buybacks into account when we're considering the yield, but we welcome them when they're done at what we think is an astute time in terms of the value of the underlying stock.
Yeah. I mean, does that in any way give you challenges when you're trying to sort of generate a portfolio that itself pays a yield, or do you find that's pretty manageable? I was just wondering if there was perhaps a sort of shift more towards returning capital via, bear in mind it's a global portfolio, so if you're looking at a UK portfolio, you tend to get a lot more income from that. If you sort of see a shift overseas, I just wonder if it makes it a slightly awkward balance to achieve.
Well, it's interesting, isn't it? I mean, this is not a new question, and it tends to be that income portfolios, which are inherently fairly conservative, both in terms of the return which they generate. So, as I was mentioning, for a certain cohort of investors, we believe covering a proportion of your outgoings by our income, as well as having capital growth, is an attractive thing to do. So, I think of it, if you can spend 3% of your capital on day-to-day bills, you can compound the underlying capital elsewhere at 6 or 7%. So you double your capital every 10 to 12 years via the rule of 72. That, as an overall return stream, is a very attractive, I think, for a proportion of your investors. You've got other things that are going to probably compound at a higher rate, but be more volatile. You've got the 2-year, which is giving you 5% nailed on, but you're going to face reinvestment risk at some point as interest rates come down. We're somewhere in the middle, and I think that makes sense. And when things have been good, and boy, they've been good for a while, that whole sort of idea of how one should be allocating capital, the solution that you're wanting your capital to do for you, gets a bit lost in just trying to outperform a very strongly performing index. But I still think it's a valid concept. What it does mean, and actually, for instance, the MSCI high yield and the MSCI world, which are two different benchmarks, used to trade pretty much in line with each other. In fact, the high yield outperformed the world yield for a long time. There's obviously been quite a divergence between those two recently because of the performance of very large, unyielding technology companies. That does mean that our opportunity set is somewhat different to a more of a growth manager. But equally, it means that we are, I mentioned, I suspect we're at extremes in terms of valuation, positioning, sentiment, concentration, so on and so forth. We're an antidote to that. Prevents us from having too much in those sorts of areas and having too concentrated a portfolio and having too expensive a fully valued portfolio. And I know that makes us look pretty dull and conservative now, but actually that could become very valuable at some point.
Yeah, absolutely. We've got a few questions coming in. I thought perhaps just have a quick look at some of these, particularly there was one who was just talking about tobacco stocks. And somebody just asked a question, have you now sold out of tobacco stocks? And if so, why? But from what you said, I think you've still got some holdings. Is that right?
We do. So it's interesting to us, and I wouldn't want to push the argument too strongly, but actually now, because of the range of smokeless tobacco, non-tobacco offerings, there are no companies in the world that are doing more to reduce the incidence of smoking than the tobacco companies, because they're giving people a much healthier alternative, and it's creating ultimately probably a faster growing, more sustainable underlying business. And I think the recent re-rating of Philip Morris is telling you that. So the single greatest contributor to our return in STS since we began to manage it at Troy is Philip Morris, interestingly enough, echoes the fact that the single strongest performing stock in the US market between 1950 and 2000 was Philip Morris. And some of the reasons for this is, of course, because of the litigation worries, it tends to mean that these businesses trade at discounts to otherwise where they would. And if you reinvest the dividend that they pay you, you compound capital at quite a high rate because the underlying shares are relatively cheap. So that dynamic exists, and we've seen that, and they tend to also perform when times are a bit more troubled. And so we've seen decent performance this year, and we expect that to continue. So we've maintained our holdings for now.
Right. Okay. Let's have a quick look. I think this relates to sort of some of the consumer stocks we were talking about, but somebody has asked, how long have inventory issues / overstocking been dragging on these companies?
Yeah, well, quite what feels like a long time. I mean, in investment terms, 12, 18 months or whatever is not a particularly long period of time, or at least we shouldn't allow it to be a particularly long period of time in our minds. But it doesn't mean it's painful. So the drawdown of Diageo post the COVID boom from sort of 2021 to now has been painful. And that is largely a result of inconsistent demand, but also leading into this inventory issue. And again, results from Pernod yesterday are saying that is still a reality. But we think the way one should think about this is that what you're being offered is, and this is why we've been adding to this area, is an opportunity. We don't know exactly when the inventory overhang will clear, not least because they call it pantry loading, don't they? People bought quite a lot of things in COVID, as I say, and they're slowly working their way through it. But they will get through it eventually, one would think. And so you're being offered the opportunity today to buy a very high quality business, even in the knowledge that maybe this is going to go on for a bit longer. But on a 10-year view, we think that the underlying attributes that we all know about of brands and distribution and the fact that people are drinking more spirits relative to wine and beer because for all sorts of reasons, weight loss, because it's more Instagram friendly, you tend to be much more loyal to your spirits brand than you do to other brands. When you walk into a pub, you don't really care what beer they serve, but you do care what vodka you drink or what gin you drink. And in the case of Diageo, they've got a wonderful position in the US, which I know is having a bit of a tough time at the moment, but ultimately it's a very attractive area to be. And Pernod remarkably commands a remarkably large proportion of what is currently a very low. So the amount of foreign spirits sold in China and India is actually a very small proportion of the overall market, but they dominate that bit. So on a 10, 15, 20-year view, we think that remains a fantastic opportunity. And so, we think even though there's, quite a lot of uncertainty about the inventory issue today, we think it's a decent time to be buying.
Okay. You've mentioned it a couple of times. I just wanted to perhaps sort of recap on this, the sort of long-term view. So when you're thinking about your sort of investments, what kind of horizon do you have in mind? And I guess,
as implied,
turnover?
So we've got 9% turnover, so 10 plus years.
Right.
And so that has a couple of implications. The first is that we might well not it's very rare that you actually buy at the low, at the bottom. We're probably
Yeah.
going to buy around the low, and Pernod is a good example. I keep mentioning Pernod, but it's a good example. Another recent example would be something like Amadeus, which is the airline software business in Europe, which we've been buying. We think looks cheap here. It's had a disruption from COVID, but we still think, and people are worried that it's going to be disintermediated in a way that we don't think is right. And actually, they've got a great airline IT business, which is positive in terms of margin, but also growth. And we think for all that together, it's going to be a terrific investment from here. But we're buying it on a 10-year view.
Yeah.
That also means, of course, that we highly select about the businesses that we're buying. And we don't try and morph the portfolio to necessarily be in the right place for any particular part of the business cycle. We try and buy businesses when they're inexpensive and allow them to compound. What that means, obviously, is at particular points in the cycle, and now is a good time, we can look quite a long, quite different to the market and sometimes quite a long way offside. But we think that approach of focusing on quality, trying to buy value, optimizing income quality and growth, allowing them to compound for 10 years over time, if you have the patience, really should work.
Yeah. When you describe that, it sounds sort of very Buffett-esque. Is that fair? Or do you think that's maybe...
Well, I'd hand my hand, I am a disciple of Buffett and his way of investing, and the idea that you should try and divorce the long-term competitive advantages of a business from short-term trading in your mind. The competitive advantages are what make the business attractive. The short-term trading is probably what gives you the opportunity to buy it cheaply.
Yeah.
And so we absolutely, the key driver of returns ultimately for Troy, for our equity investments, is likely to be the sustainability or otherwise of a company's competitive advantages combined with an eye on value, rather than seeking to second guess short-term trading.
Yeah, that makes a lot of sense. Just quickly to see what other questions we've got here, because I've got quite a few. How many shares do management hold in the trust?
I think we did put it in the annual report actually, but I own quite a lot of shares in the trust, and I've been buying more. Tom Ash, with whom I work, who helps manage the trust, also owns shares, so we are eating our own cooking. Yeah,
you're well aligned. Okay, that's good. With the issues going on in China, will we see a two-tier of cyclicality with developed world sort of decoupling from developing? Do you have a view on that? I mean, it feels perhaps a bit too macro for you, really.
No, I'm very happy to comment on that. Decoupling is a dangerous word. I do think that actually China has idiosyncratic issues at the moment which aren't going to go away. Not just short-term property and capital cycle problems, but also demographic problems, as we know. It's always been the worry that China gets old before she gets rich. And I suspect that might actually be what's going on here. But I think it's dangerous to see that as to see that maybe China you can divorce from the rest of the world. I agree. Can you divorce China and emerging markets more broadly from the rest of the world? No, I'm deeply skeptical about that. We've seen many times in the past that one can be ahead or behind the other, but ultimately they tend to be highly correlated, particularly at times of stress, and I don't see that this should be any different.
Right. Okay. That makes a lot of sense. Another question, also from the same person. How do you view the differing growth rates of these two types of economy? So how does it affect your stock selection decisions? I'm guessing because you're focusing on the company, probably not a lot, but...
Yeah, well, also because, as you know, it's always dangerous conflating economic growth with stock picking. The two are not quite the same thing. Where they do unify or become more one thing is in points of recession when... a declining GDP number also tends to give you a declining stock market. The opposite is not necessarily the case. What I think the way we see that is that rather than trying to forecast economic growth, we try and identify assets that we want to buy and then buy them when they're inexpensive because of a lack of economic growth, if that makes sense.
Yeah.
We think forecasting long-term GDP growth probably doesn't have a great deal of use for investing in equity portfolio.
Okay. Now, another sort of question here. How have sort of higher financing costs impacted the CapEx plans of your holdings? I mean, my gut reaction is probably not that much because we've already said that, fundamentally you're focusing on things that have got a lot of sort of free cash flow, as it were, or sort of good at generating it. But do you have a view? Has that sort of changed some things at the margin?
It's interesting. I mean, every cycle's different, obviously, and this is particularly different because of post-COVID, and also because I'm sure you've seen the same data that I have, because some of the very large companies have very large cash balances, means that the increase in interest rates has been offset to a degree by increased interest income relative to companies who are more indebted and therefore more challenged. We obviously ask our companies about that. We like our companies to be relatively conservatively financed. It's often the case that when a company comes into Troy, we're asking them to reduce their levels of net debt to EBITDA, and they tell us that their US investors are asking them to increase their level of net debt to EBITDA. So it's a sort of game that not a game. It's a debate that we have, and we are very focused on capital allocation. So we do always try and impress upon management teams that when they deploy debt, particularly if they use it to buy back stock rather than deploy capital in the business, should take into account the value of the share that they're buying. I guess the real answer to the question is, and also of course there's a delay because a lot of companies turned out their debt, as did individuals, as did everybody, but famously not the Treasury in the US, who tend to be fairly short-term financed. But that's why it's taken a while to come through. Because it takes a while for the interest reset to happen, and that's one of the reasons why I suspect the slowdown's taken place more slowly than we expected. You know, we've been expecting that for a while. We've been early. Doesn't mean it's not going to happen. So yes, we look at it on an individual stock by stock basis. We're surprised it hasn't had a greater impact on the economy than it has so far, but we don't believe that necessarily means that it's not going to happen. Clearly, as we know, a recession or slowdown tends to take place somewhere between 12 and 18 months after the last interest rate rise. We're still comfortably within that window. And so we don't think it's particularly impactful on our portfolio, but we do suspect that it may well be impactful for the economy more broadly.
Yeah. Okay. Now, somebody's sort of asked, I think we've got this on our website anyway, but somebody's asked, what are the sort of fund charges for this? And I guess, in a way, maybe it's just an interesting time to explore. Obviously, you've got the open-ended funds. Kind of what's the overlap between this and I guess also what sort of differentiates STS perhaps versus your open-ended equivalents?
So they're run bang in line with each other in terms of the underlying portfolio. We do that intentionally. It tends to be for us that if people want to allocate substantial sums of money, they will buy the open-ended structure, and if they want to allocate slightly smaller increments, they'll buy the closed-ended. The thing that makes it different is only really two things. Number one, of course, there's a board. They have an oversight, and I'm obviously answerable to them, and so therefore you have someone on your side, so to speak, as a shareholder. Three things really. Number two, there is an element of gearing. The portfolio is about 5.3, something like that, 5.4% geared, so not substantially so. We have an agreement with the board that we could take that to as high as 9-10%. Again, that would be done in consultation with the board. But that's the sort of level that investors should expect as an upper end. But given that I started by saying that I think equities are pretty fully valued, we'd like to be increasing our level of gearing when we think that they're less fully valued. Makes perfect sense to me anyway. So they're the main differences. I guess the other point says we have a discount control mechanism within STS, so there isn't really a difference in terms of liquidity between the open-ended and the closed-ended, which sometimes one might expect to see. And further, you won't see the closed-ended trade at a substantial discount, which you might see in others. Open-ended and closed-ended funds run alongside each other, so they're much more similar than they are different, but there are some subtle differences. Okay, no, that makes a lot of sense. I mean, do you have holdings in both, or? I do, yes. I have more in the closed-ended than I do in the open-ended, actually. No, that would make sense. Presumably taking advantage of the discount, I'm guessing. I like STS. I like having money in the investment trust. Just going back very quickly to the sort of gearing. Obviously, you're saying markets are more fully valued, so you're sort of naturally concerned you're more conservative on this, and would obviously be looking to deploy sort of more capital, if there's been some sort of reset. I guess what would you see as a sort of natural level of gearing for the trust? And if you're particularly cautious on markets, I mean, would you take that right down? Would you potentially, obviously it's more of a board decision, but would you think that, there would be the potential to go net cash if you were really concerned? So again, as you say, it's a decision taken in consultation with the board. But from a sort of philosophical perspective, we could yes, we could take it down to 0. We could take it up to 10. That's the range investors would expect. I would be very surprised if we then went further than that to net cash, as you say. I don't think you should expect us to do that.
Yeah. So you'd always expect this to be at least permanently invested, as it were.
Yes.
Yeah. Okay. Just obviously on the income, because obviously it's a nice component of this. Obviously, you've got the cash or the dividend income, etc., distribution from the underlying portfolio. Do you supplement that in any way? I know sort of some funds will write things like covered calls, etc. Is that something you guys do, or do you steer away from it?
Funny enough, STS has done that in its past. And having managed the real return fund or helped manage the real return fund and the use of options and futures is something I'm quite comfortable with. It's not something we've done when we were entrusted with the management of the trust by the board. We decided not to continue that program of call or put writing, call writing, I think it was what they were doing, for a couple of reasons. First of all, because going right back to where I started, we want to be seen as, Troy is a conservative, intuitive, perhaps, worthy, perhaps, investor, and we want what we do to be simple and straightforward. It's the old simple but not easy, and we don't think that call writing is consistent with that. Secondly, it's interesting that one of the most mean reverting things there is volatility, and so the best time to be writing calls is when volatility is elevated, because you get the best premium, obviously. But almost by definition, you're going to struggle to replace that income on an ongoing basis when volatility mean reverts. We want our income to be more backed by genuine cash flow and to be progressive over time. So we don't do that. The other thing we don't do currently is we don't distribute capital. Many of my investors have heard me say before, the delineation of income and capital goes back to the Crusades. It's not a new thing. And I know that within the closed-ended structure, it is possible to use the structure to distribute a degree of capital, and that's something we could do in the future, potentially. We don't do it currently. And so that gets back to the sort of kind of where you started, 2.9% dividend yield. You could say that's quite low in some respects. I actually think that's very reasonable. How much income should you take? Going back to what do I want my capital to do for me?
Yeah.
What do I think is a sensible solution to my investment needs? Well, actually, I think if you think about long-term bond yields, long-term interest rates, kind of 3% in terms of a proportion of earnings yields long-term, or 10-year bond yields long-term, is a sensible level of income to take from an asset, I think, from an equity asset, particularly if it's growing over time. And so, a couple of journalists have asked me, we've got 5% on the 2-year gilt now. I didn't look this morning, but we still got a decent yield on the 2-year gilt. So why do I need you? Thanks very much. But the answer is they're doing two different things. And actually, the fact that we can get income on bonds now is to be celebrated. Not great for mortgage holders, obviously, but it's fabulous for investors. But you get certainty of income from bonds, and you get growing income from equity, and the two are complementary, not in conflict. And so it goes back to what I was saying. Over here, you've got the 2-year, 5% nailed on, but at some point, you're going to face reinvestment risk. Over here, you've got, all-out growth. It's been fantastic, but you're going to face probably quite a serious drawdown at some point. We are somewhere in the middle, and we think that 3% is a sensible, funded, progressive, growing income yield. Yeah.
Obviously, because it's important. What do the reserves look like?
So we have decent reserves. I don't have the number off the top of my head. I should, but we have a proportion of each year's distribution in the reserves, and therefore we can have a degree of confidence that the income will be able to be grown consistently from here. And that is one of the objectives of the trust, is we are both trying to have a dividend that's sustainable and growable and gently build the reserves over time.
Yeah, gives you obviously a bedrock. Just interesting and question here. Now, somebody said, how much stock selection added to performance during the last year? But obviously, I'm thinking maybe be interested to comment on that, but also perhaps what's happened longer term, bearing in mind that obviously you've been managing this since 2020. Is that right in my head?
That's correct. Yeah. So it's a completely fair question, and part of why our performance has been, our performance was actually, I suppose someone's got to say it was actually very good as recently as August 2022, which I know in some respects quite a long time ago, but in investment terms is actually not very long ago at all. And since then, we've been sort of tracking more or less sideways while the market's been doing rather better. But actually, we've been picking up again recently. So And that's echoed in the performance. For instance, I know I keep mentioning it, something like consumer staples, which again did very well in 2021. Since then, it's been somewhat sideways as it picked up. Or perhaps ADP and Paychecks, again, did very, very well and has been tracking sideways. But on an underlying basis, these businesses have been continuing to grow and continue to compound.
Yeah.
We can never control when returns are going to be delivered, but we can control the extent to which our businesses are compounding an underlying rate, and that does continue to be done satisfactorily. There have, however, been one or two idiosyncratic disappointments, which we hold our hands up, and is why we've made a couple of mistakes and has been costly performance. The first is Reckitt Benckiser specifically. I did mention it. This is a business ultimately we think is well placed. We like consumer health businesses. They have attractive margin structures. They have good brands and market positions. When you're not feeling very well, you tend to be very brand loyal and quite price insensitive. And ultimately, for those reasons, they tend to be pretty good businesses. And we have both Reckitt Benckiser and Kenvue, which is the consumer healthcare business spun out of J&J. It's actually performed a bit quite nicely recently. The problem is you're also a sort of pharmaceutically type business. So you're neither a completely branded consumer good business, nor are you a pharmaceutical business. And so you attract litigation risk. And unfortunately, Reckitt's made what we thought at the time was, and maybe there's a lesson there, but we thought that their acquisition of their infant formula business, they could have been more patient and bought better assets that came available from spin-outs from other businesses, and they didn't. And we've had this really, really horrible, there's been a few strategic sort of missteps over time. We think the business was underinvested. We did identify that. They had a bit of a boom in COVID because obviously they make the stuff that cleans houses, and they've used that to reinvest in the business. Had a change of management. We felt the business was finding its feet, and that's why we had a reasonable allocation to this business, and it looked relatively inexpensive. And then they've been hit by this horrible court case in the States, which for those who've been following it, effectively, for very premature babies. And it's very emotive because we're talking about babies and a very serious condition which can ultimately lead to their death. It's a horrible situation. And the contention is that human milk is much better for premature babies. No one disputes that. But where human milk is not available in a clinical setting, prescribed by a neonatologist, they do sometimes use formula, because what else are you going to do if you've got to do something? And it's known that the formula doesn't give as much protection from this particular disease, very nasty disease with NEC, as human milk. But that doesn't mean that you shouldn't necessarily use it. Now, what's happened is that I think juries in the US have been persuaded by barristers that these British companies come over and persuaded people to use milk that they claim is just as good for you as human milk, and no one's claiming that. And I think they've sort of confused correlation and causation. And we think ultimately when it moves to a jury, to a trial by judge as opposed to jury, and it all becomes a bit less emotive, the logic of that will become apparent. And so, though I think the US litigation, the US court system being what it is, Reckitt's unfortunately will have to come to a settlement at some point to close it out. And that number ultimately, I suspect, will be a great deal less than the current, as I said, fall in the share price implies. So it's a horrible situation. It's really unfortunate. I feel very bad for the company. I think ultimately it's manageable, but it has knocked the share price in the short term, and it's been very costly for us because it was quite a big holding and it's fallen quite a long way. So the next question is, have you bought more? And the way we think about this is that there's ultimately, we want to have in our mind how much capital you actually want to put into a business from a starting point. How much of your NAV do you ultimately want to put into a business? And if you keep averaging down, then you can end up putting 7, 8, 9, 10% of your NAV into a business, which, yes, you liked, but did you like it that much? And so we need to be a bit careful about just because something's falling, you add more. Having said that, because we think the liability will be less than currently is shown, because we think ultimately the underlying business is improving and is in a decent place and is looking very cheap now, we haven't sold any. So we've neither bought nor sold, and we're holding the position that we have. And the second one is to highlight would be Diageo, which, as I mentioned, it's an industry that has a degree of cyclicality, but only within the context of staples and not really within the context of other much more cyclical businesses. But it has had this post-COVID cycle, and that's been costly to us too. And finally, we did have a Link REIT holding, Link REIT in Hong Kong. I hold my hands up. Rates have gone up much faster and much further than we thought was the case. We thought they couldn't go up that much because there's too much debt without causing a real issue.
Yeah.
And I mentioned why it is we think that the slowdown's taken a bit longer than people might think, and why we thought. But actually, that asset, as interest rates are beginning to come down, is beginning to perform a bit better. So, hold my hands up. There have been one or two stock idiosyncratic mistakes. We think ultimately they'll come right, but that has been costly to performance. Conversely, there have been some winners as well, but we don't want to do it. That wasn't really the question.
No, absolutely. Just conscious of the time. I've probably got time for a couple more questions here. Somebody sort of asked, given the large cap and sort of potentially cyclical nature of some of the holdings, does the portfolio carry a lot of beta to sort of global markets, stroke GDP? I mean, my experience, those two are kind of different things anyway. But have you sort of got a comment on that at all?
So I have. So the answer is it doesn't. I don't think they're very cyclical. In fact, I would say it's the opposite. Consumer goods, healthcare, software. Generally, these are low cyclical industries, as opposed to something like a bulk chemical company or a house builder or these much more cyclical businesses. Arguably, our beta has been. We should have had a bit more. We would perform better had we had more beta. But for all the reasons I said about expectation of the slowdown, elevated valuations, choice conservative approach. We've had a portfolio that we will do very well in a more stressed environment, and I think that's a message that's become clear. That doesn't mean the beta's fixed. Of course, it's always a mistake to think that the current opportunity set is the only opportunity set you're ever going to be offered. And we think that, given that anything can happen in markets, we think that the future opportunity set could be pretty radically different to the one that we are currently being offered. And there's three areas where I would highlight that. Number one is the consumer, and we are beginning to see high quality consumer assets fall to a level which is much more interesting than they've been for some time. I would highlight a business like Nike or LVMH or Starbucks. So that's point one. We would like to allocate to this. The cost of living crisis is real. I don't want to sound like a heartless fund manager, but because of the sentiment surrounding that might give us an opportunity to buy businesses cheaply because people are worried about precisely that. The second is industrials. One mistake we've made, if you like, or one area we've been under allocated both relative to where we want to be and relative to our peers, to our cost, has been industrial businesses. We've got a number of really high quality industrial businesses we'd love to buy, including semiconductors. But we felt them to be too expensive, and they've got more expensive. I'm afraid in the short term, that hasn't been the right thing to do. But it does strike us that there are a number of high quality industrials which traditionally traded far below where they do, not just a bit, but a long way where they do today. Not quite sure why that is. Maybe it's because of the capex boom in the States. Maybe it's because of the extended investment cycle. Maybe it's because investors have become habituated to have higher valuations. Maybe it's because of the zero interest rates that we enjoyed for so long, and so on. But we think they could be radically different valuations at some point, and we could allocate really quite a lot of capital to that area. And the third is the non-bank financial businesses. So private equity businesses, private investment businesses, and so on. These are lovely business exchanges. These are lovely businesses. They're keyed into the level of an activity in capital markets. But as I said, we think capital markets are pretty fully valued outside government bonds. And so we want to be patient about that. But if we were to allocate capital to all three of those sectors, then in a quality conscious or quality adjusted way, the cyclicality of the portfolio on an underlying basis could increase quite materially, but without compromising on quality.
Okay. Right. We're almost at time. So probably just one last thing, just to sort of wrap it all up. I guess sort of why STS and why now?
So I think hopefully I've made that clear. So why now, to take the second part first, because we think that you have this unfortunate combination of potentially an economic slowdown in combination with pretty elevated valuations and a more conservative balance between income and capital, concentration on the downside, highly cash generative group of businesses, typical of a Troy portfolio, could be exactly what you want to buy right now. And it's certainly not what investors are focused on. So that's why now. They're much more focused on NVIDIA or whatever. Why now? And then why STS? Well, it's the point I was making about for a particular cohort of investors, particularly those who have irreplaceable capital and in this case in need of income or desirous of income, then we think the combination of being both high quality and having a balance between those two sources of return is an entirely sensible thing for investors for a proportion of their money to have. So I think hopefully that answers why STS and why now.
Excellent. Well, look, thank you for that, James. I think we've one, it's been an excellent presentation, been great discussion. I think we've covered a heck of a lot of ground.
Well,
And I
absolutely.
think we've got through all of the questions as well. But as I say, that's been really, really interesting. So hopefully we can get you back in a year or so, and we'll see how you're doing.
Well, absolutely.
So thank you for this morning.
Thanks very much, Matthew.
So very quickly, if I just skip to the end before we tie it up. So thanks everybody for joining us today. Obviously, we've got some things coming up. Chelverton UK dividend, David Horner, 6th of September. Impacts of environmental markets, 3rd in September, John Foster. And then we've sort of got our quarterly panel show, New Government, New Opportunities on the 20th of September. And you can see we've got Neil Herman, David Burge, Georgina Britton and Duncan Ball. So really interesting mix there. And then sort of finishing off September, Simon Tilstone from Warehouse Re. And as you can see there, actually, we've got a few things booked up. In fact, we've already got most of October booked up. So full program to bring you to you there. But once again, thanks everybody for today. And we'll see you again next week. Bye for now.